there is a strong probability of higher gold prices. Past precious metals bull markets and the performance of these bull markets, $35 to $850, pardon me, in the 1970 to 1982 bull market, $250 to $1,900 in the 2000 to 2012 bull market. Russians are the most important suppliers of natural gas and the second most important suppliers of crude oil to Europe. And the consequence of the drama that we've seen in Russia has reinforced both strategically to governments, but also to investors, the importance of access to diversified supply worldwide. And I think it's changed the value of legacy deposits, high quality legacy deposits around the world. If you're Japanese, you don't want to be solely reliant on Saudi suppliers or US suppliers or Russian suppliers. Everybody has learned that despite the fact that we're moving in a balkanized fashion to resource nationalism, that the global economy is much more interconnected, and you need diversity and security of supply. It's extremely important. And I think that lesson's been brought home. I personally consider to be cash, albeit volatile cash. And if you consider, as an example, PSLV or silver to be cash, you have to be willing to sell it, even at a small loss, during periods of time where you need the cash for higher and better purposes. So for me, I regard physical precious metals or physical precious metals surrogates as good but volatile cash. Perhaps you should call them liquidity. The first challenge is that if the real interest rate in the United States goes less negative, that is to say, if the Fed actually is able to increase the interest rate market in the United States, a circumstance right now where the U.S. 10-year Treasury is yielding 2 in a currency that's depreciating by 6.5% a year is a no-brainer for gold. But if the interest rate were to go up, that is to say, if the 10-year Treasury or CDs or other savings products began to offer a better relative value, that would be harmful to gold. But a second thing that could happen to precious metals in the nearer term that people need to take into account is the fact that maybe the only asset that the Russians have that they can turn into cash right now is gold. Gold is fungible. Gold could be sold by the Russians to, as an example, people in Dubai and be rebranded as Dubai Gold. Now, maybe the Russians would have to take a discount. And I'm certain that the Russians don't want to sell their gold, but I think the Russians might be putting themselves in a circumstance where what they want is somewhat less relevant than what they can have. And I think I think gold holders need to be considerate in the next 6 months about the possibility that the Russians have cash needs in terms of consumables and imports in their society that they can't fund through normal commodity sales, which would settle in US dollars. If we look out further, I think both the interest rate challenge and the Russian challenge are easy to overlook. Easy because I think that on a global basis, the economy of the world, but in particular the U.S. economy, can't stomach the most obvious alternative, particularly for imports from China and India, would be gold. And that might put pressure on the gold price. And I think that people who get their sense of value around gold from the price quotes day by day and would be overly concerned about a fall in the gold price from, say, 1,950 to 1,750, need to consider the fact that that's a possibility given Russia's cash needs in the next 6 months. The U.S. 10-year Treasury, the world's benchmark security, has offered a positive real yield with, depending on which government agency you listen to, the depreciation of the value of the U.S. dollar being between 6.5% and 7.5%, and the U.S. 10-year Treasury yielding 2%, The real yield on the U.S. 10-year Treasury is a function of taking 2 and subtracting 6.5, a truly ugly number. If we were to revert to mean in terms of pricing of the U.S. 10-year Treasury, then the interest rate would have to rise to 6.5 or 7. Can you imagine the impact of the federal, state, and local budgets of a tripling or quadrupling of their interest charge? Can you imagine the impact on consumers if their credit card interest rate doubled? Can you imagine, too, if the 30-year fixed mortgage rate returned to mean? Because the 30-year fixed mortgage rate has traditionally traded at a premium to the 10-year Treasury rate. If the 10-year Treasury rate went to 7, that would suggest that the 30-year fixed mortgage would have to trade at 8. There could be a near-term impact on gold if the nominal interest rates go higher. But I don't believe that the policymakers will be able to afford an honest economy, an honest interest rate environment for the next 5 years. And the consequence of that is that from my point of view, there is a strong probability of higher gold prices. When people ask me why this hasn't been reflected to the market, I ask them to reflect on history. Perhaps because I'm older than most of your viewers, that's easier for me because I lived through history. But I remember, although I was only in high school, in 1967, 1968, the writing was on the wall for higher inflation. We had the war in Vietnam, which of course we lost, and the war on poverty, which we lost too. And we had a circumstance in the 1960s where we were living beyond our means. And we began to inflate away the difference between our obligations and the net present value of our servicing capabilities through inflation. But the consumer didn't pay attention. The consumer had lived through the 1950s and most of the 1960s, which were very benign economic times. And the consequence of that is that the academic subject of inflation didn't attract any action until the consumer had lived through 3 or 4 years of inflation. I would ask people, too, to consider past precious metals bull markets and the performance of these bull markets. Although from trough to peak, these markets were extraordinary, $35 to $850, pardon me, in the 1970 to 1982 bull market, $250 to $1,900 in the 2000 to 2012 bull market. In both markets, there were periods of volatility where the market declined by 25 or 30%. And certainly in the case of the 1970s bull market, there was a hiatus in the middle of the market that saw the gold quote decline by 50% without derailing the bull market.